Hello everyone, this is Victor here. Welcome back to the Intelligent Investor channel. In today's video, I'm going to talk about why I believe SPGI stock or S&P Global can outperform the S&P 500 index over the long run. Personally, I always like to invest in the best companies that have great management, wide economic moats, and increasing earnings over time. And I like to buy them when their stocks are traded below their intrinsic business values, so there will be a good margin of safety to reduce risk. Here's the interesting thing about S&P Global's business. S&P Global is the largest credit rating agency in the world. Many companies and government agencies around the world use S&P's credit rating service to rate their debts and rate their abilities to pay off debts. Also, S&P Global owns 73% of the S&P Dow Jones indices, which owns the S&P 500 index. This allows S&P Global to earn fees based on the amount of assets under management, or AUM, that is invested in ETFs and index funds that track the S&P 500 index. So in this video, I'm going to talk about why I believe S&P Global or SPGI stock can outperform the S&P 500 index over the long run. I will also talk about why SPGI is one of the best dividend growth stocks. You will learn about these topics in this video. SPGI's business model and financials, SPGI's wide economic moat, SPGI's long-term growth prospects, SPGI's biggest risk to consider, SPGI stock valuation, and will I buy SPGI stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent and create many excellent stock analysis and investing videos every week that will help you become a great investor. The link is in the video description. Take a look, let's start. So what is S&P Global's business model and how does the company make money? S&P Global is one of the leading providers of credit ratings, market data and analytics, market insights, benchmarks, market indices, and workflow solutions in the capital market, commodity market, automotive market, as well as engineering market. S&P Global's main customers include asset managers, investment advisors, large institutional investors, investment banks, commercial banks, debt issuers, insurance companies, stock exchange, derivatives exchange, trading firms, commodity producers and traders, government agencies, automakers, parts suppliers, dealerships, and engineering firms. S&P Global or SPGI has 5 major business segments: market intelligence, ratings, commodity insights, mobility, and S&P Dow Jones indices. SPGI tends to divest businesses that do not have much growth and that have a very low operating margin. For example, SPGI announced that it will sell its engineering solutions business to the KKR investment firm for $975 million in cash. The engineering solutions business has a very low operating margin. In comparison, you can see all of SPGI's other businesses have much higher operating margins. Engineering solutions business also does not have much synergy with other businesses. In terms of revenue breakdown by businesses, SPGI earns the most revenues from market intelligence, credit ratings, commodity insights, and indices. SPGI also earns the most operating profits from market intelligence, credit ratings, commodity insights, and indices. Here's the important part about SPGI's multiple revenue streams. If you look at this here, you can see over 50% of SPGI's total revenue is subscription-based. After merging with IHS Markit, SPGI's recurring revenue increased from 69% to 72%. Also, according to the latest financials here, SPGI's recurring revenue increased 2% year over year to 84% of the company's total revenue. This is very important because management wants the company to have more recurring revenues than transaction revenues. So SPGI's revenue growth is more stable going forward and is not largely dependent on credit ratings transaction revenues. SPGI merged with IHS Markit in February 2022 and paid $44 billion for it. SPGI decided to buy IHS Markit because it will increase SPGI's recurring revenues every quarter going forward and help SPGI become more resilient to market downturns. Historically, S&P's credit ratings business contributed more than 50% of the total operating profit to SPGI each year, but S&P's credit ratings business is largely dependent on the global debt issuance volume every quarter. If many companies and government agencies issue more debts, S&P's credit ratings business will earn more transaction revenues. But when inflation is high and interest rates are high, S&P's credit ratings business will earn much less transaction values. This is because companies and government organizations do not want to issue too much debt when rates are high. For example, if you look at these financials here, you can see SPGI's adjusted revenue, operating profit, operating margin, and diluted EPS have all decreased year over year because S&P's credit ratings business had much lower value during the quarter. In terms of profit margin, most of SPGI's businesses have very high operating margins. For example, SPGI had an adjusted operating margin of 45.5% in the past 12 months. If you look at this here, you can see all of SPGI's businesses had very high operating margins except engineering solutions. Of course, when it comes to investing, we have to be forward-looking instead of backward-looking. Past performance does not guarantee future results, but I want to show you SPGI's past business performance here before it merged with IHS Markit in 2022. Historically, in the past 10 years, SPGI had very consistent revenue growth, consistent operating income growth, diluted EPS growth over time, decreasing diluted shares outstanding over time, and increasing free cash flow per share over time. If you're a dividend growth investor, you will want to know this. At the time of making this video, SPGI has a forward dividend yield of 0.96%. SPGI has been paying dividends to shareholders each year since 1937. SPGI has increased its dividends annually for at least 50 years. Also, in the past 10 years, you can see SPGI had outperformed the S&P 500 by a large margin while still paying dividends consistently every year. Personally, I don't mind the company paying very low dividends as long as the company has strong fundamentals, great management, wide economic moats, increasing earnings, and increasing free cash flows over time. I would rather invest in an outstanding dividend growth company that has strong fundamentals and increasing earnings over time than investing in a high-yield dividend company that has weak fundamentals and decreasing earnings over time. According to Morningstar, S&P Global has a wide economic moat because of the company's intangible assets and network effects. So what do you mean by intangible assets and network effects? According to Morningstar, S&P Global's well-established benchmark businesses warrant a wide Morningstar economic moat rating based on intangible assets and network effects. Credit ratings provide value to bond issuers as well as bond investors, creating a network effect. Bond issuers value credit ratings from Moody's and S&P because of their wide acceptance among asset owners and asset managers. This is particularly important in cross-border bond issuance deals. While a local country's domestic rating agency could have value for its domestic bonds, a rating from a big three firm is critical for a cross-border marketed security, as global investors desire broad comparability across global bonds. For example, an investor wants to know that a B+ rating for a company in California is similar to a B+ rating for a company in Chile or a B+ rating for a company in India. This broad acceptance makes it essential for corporate issuers to get a rating on any debt they issue. By getting a bond rating from a market leader such as S&P, the bond issuer pays less in interest, often 30 to 50 basis points in savings per year. The cost of a vanilla corporate bond credit rating costs around 7 basis points and is typically much less than the underwriting fees and legal fees, 50 to 100 basis points combined. To receive a nationally recognized statistical rating organization designation, which bestows many advantages from the SEC, an agency must be nationally recognized by the predominant users of ratings in the US as an issuer of credible and reliable ratings. However, this creates a bit of a chicken and the egg issue, because for a rating agency to be credible in the eyes of capital market participants and corporate issuers, it's going to need to be an NRSRO. Even though the number of firms with an NRSRO designation has increased to about 10 since the introduction of the Credit Rating Agency Reform Act of 2006, we believe the network effect has been strong enough to result in limited traction of other rating agencies. S&P Dow Jones Indexes has built a strong moat with its flagship benchmark, the S&P 500 Index. S&P monetizes its index in primarily three ways: index subscriptions, asset-linked fees, and transaction royalties on exchange-traded futures and options. Active asset managers pay to benchmark performance against an index. Index benchmarks are critical to asset owners, asset managers, and consultants, and they often have little incentive to switch benchmarks. Once an index becomes dominant in a certain segment and has widespread acceptance among stakeholders, it tends to stay that way. An asset manager may prefer to be indexed against the Russell 1000, but if asset owners and consultants prefer the S&P 500, the asset manager will risk outflows. The largest ETFs in the US are based on the S&P 500 index, and we believe S&P Dow Jones indexes has strong brand awareness among investors. I believe SPGI has two biggest competitive advantages that are very hard for competitors to copy. The first is S&P's credit ratings business. There are only three major players in the global credit ratings industry. They are S&P Global, Moody's Investor Services, and Fitch Group. S&P Global or SPGI is the largest of the big three credit rating agencies. According to CFI, the big three credit agencies control 95% of the rating industry. Moody's and S&P are located in the US, and they dominate 80% of the international market. Fitch is located in the US and London and controls approximately 15% of the global market. It's nearly impossible for new competitors to enter the credit rating agency industry and to compete with the big three because the new competitors will need to be registered as a nationally recognized statistical rating organization or NRSRO from the SEC. The new competitor will need to be well known and well accepted by most financial institutions, most corporations, most market participants, and most government agencies. According to the SEC site here, there are only 10 firms that are recognized as NRSROs. Of course, the big three credit rating agencies are the most well-known NRSROs. SPGI's second biggest competitive advantage is only the S&P Dow Jones indexes. SPGI owns 73% of the S&P Dow Jones indexes. The other 27% is owned by CME Group, one of the largest derivatives exchange. S&P Dow Jones indexes owns the S&P 500 index, which is the most popular large-cap US stock market index in the world. Many investors invest in ETFs and index funds that track the S&P 500. SPGI earns fees based on the amount of assets under management that is linked to the S&P 500 and all the S&P related indexes. This means the more money that is invested in S&P 500 ETFs and index funds, the more money SPGI will earn every quarter. SPGI also earns licensing fees, royalties, and subscription fees from companies that use the S&P 500 index as a benchmark or use the S&P 500 to make derivative products. In terms of long-term prospects, I believe SPGI's businesses will still perform very well over the long run because of the wide economic moat and the large competitive advantage I talked about earlier. In the short term, I believe S&P's credit ratings business will still be impacted a lot in 2023 because the global debt issuance market still has not recovered yet. As long as inflation is high and interest rates are high, many companies and government organizations do not want to issue too much debt. I think it will probably take 2 to 3 years for S&P's credit ratings business to recover. S&P's credit ratings business will recover quickly when the global debt issuance market starts recovering. I believe S&P's credit ratings business will start recovering in 2024 when the US Fed starts pivoting and lowering interest rates, which will encourage more companies and government agencies to issue more debts. This from the most recent Investor Day event. In the short term in 2023, management expects that the company's revenue will grow between 6.5% and 8%, and EPS will grow at a low double-digit rate. In the longer term, by 2025 or 2026, management expects that the company's revenue will grow between 7% and 9% annually. The adjusted operating margin will be between 48% and 50%, and EPS will grow at low to mid-teens annually. Management also expects to return 85% of free cash flow to shareholders in the form of dividends and share buybacks each year. I want to share with you a comparison here. According to Seeking Alpha, SPGI's consensus revenue is expected to grow between 6% and 8% each year over the next 3 years. And SPGI's consensus EPS is expected to grow between 13% and 16% each year over the next 3 years. These consensus forecasts are very close to management's forecast for the next 3 years. In my opinion, assuming there will be a recession in both the US and Europe in 2023, I think it's better to assume SPGI will have a very low revenue growth or no growth in 2023. Then once the Fed starts pivoting and lowering rates in 2024 or later, then we can expect all of SPGI's businesses will start growing again, especially SPGI's credit ratings, market intelligence, and indices businesses. In the short term, I believe SPGI's biggest risk is a continuous slowdown in the debt issuance market. Because of high inflation and high interest rates around the world, SPGI's most important business is still its credit ratings business. SPGI's credit ratings business is largely dependent on the volume of corporate and government debts that are issued every quarter. I said this earlier, the more corporate debts and government debts that are issued every quarter, the more money S&P's credit ratings business will earn because many companies and governments rely on S&P Global ratings to rate their debts. But here's the problem. If interest rates continue to be very high around the world, many companies and governments around the world will want to delay issuing more debts until rates are lower. S&P's credit ratings transaction revenues dropped a lot year over year in 2022, mainly because of much lower debt issuance around the world. If the US Fed continues to raise rates in 2023 and not lower rates until at least 2024, then S&P's credit ratings business will likely not recover until at least 2024 or later. Another biggest risk is that SPGI paid a very large premium to buy out IHS market in 2022. Specifically, SPGI paid $44 billion by issuing shares in order to merge with IHS market in 2022. After merging both companies in 2022, SPGI shareholders own approximately 67.75% of the combined company, while IHS market shareholders own approximately 32.25% of the company. This merger will only make sense if SPGI can achieve large cost synergies and large revenue synergies each year. By merging both companies, SPGI's management expects that the company can achieve $600 million in cost synergies each year and $350 million in revenue synergies each year. I think it's too early to know whether merging with IHS market makes sense or if it actually destroys shareholder values. It will take several years for us to know whether SPGI can achieve large cost and revenue synergies each year. Let's calculate SPGI stock's intrinsic value here so you know when SPGI stock becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog in the video description. These are the key assumptions in this calculator. First, I define SPGI's intrinsic values as its future free cash flows discounted to the present day. The discount rate is 10%. You can use a higher discount rate here if you want to be more conservative. Again, after SPGI merged with IHS market, management expects that SPGI will have $5 billion of free cash flow in 2023. Based on the short-term headwinds and the long-term prospects I talked about earlier, I believe SPGI's free cash flow will grow at a compound annual growth rate CAGR between 6% and 8% over the next several years here. Let's go over these three case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we are assuming SPGI's free cash flow will grow at a CAGR of 6% over the next several years. If we forecast SPGI's free cash flow over the next 5 years and discount the free cash flow to the present day, SPGI's intrinsic value should be around $118 billion for the entire company, or $357 per share. I'm giving this scenario a 25% probability here. Under the normal case scenario, we're assuming SPGI's free cash flow will grow at a CAGR of 7% over the next several years. Then SPGI's intrinsic value should be around $123 billion for the entire company, or $370 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're assuming SPGI's free cash flow will grow at a CAGR of 8% over the next several years. Then SPGI's intrinsic value should be around $127 billion for the entire company, or $384 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, SPGI's intrinsic value should be around $370 per share. Morningstar also estimated SPGI's intrinsic value to be around $370 per share. This means I believe SPGI is likely fairly valued at the time of making this video. So will I buy SPGI stock? My answer is yes. I will likely buy SPGI stock going forward in the upcoming months because I like SPGI's large economic moat and its large competitive advantage I talked about earlier. At the time of making this video, I don't have SPGI stock in my gold stock portfolio here. This is one of my gold stock portfolios. I also have other portfolios that have the same stocks. Personally, I would likely invest in SPGI only when the stock is at least 5% or 10% below its intrinsic value, so there will be a good margin of safety to reduce risk. Here's my forecast for the company. In my opinion, I believe SPGI has a good chance of beating the S&P 500 index again over the next 10 years. If SPGI can achieve low to mid-teens EPS growth each year and continue to have consistent dividend growth and share buybacks each year. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.